Welcome to the Financial Planning for Canadian Business Owners podcast. You will hear about industry insights with award-winning financial planner and entrepreneur Jason Pereira. Through the interviews with different experts with their stories and advice, you will learn how you can navigate the challenges of being an entrepreneur, plan for success, and make the most of your business and life. And now, your host, Jason Pereira.
Well, welcome. Today on the show, I have Jen Jacobs, a well-known expert in long-term care insurance. And I brought her on the show specifically to talk about what long-term care insurance is and how it can be of importance or use to not just everybody, but specifically to business owners. And with that, here's my interview with Jen. Jen, thanks for joining me.
Thank you for having me.
Yes, we had a little bit of some audio issues, so you may sound like you're a little bit of a robotic voice, but it's still still going to be plenty of great wisdom here. So, Jen Jacobs, tell us about who you are and what it is you do.
Well, I would be called, I guess, an insurance consultant, but I have a specialization in long-term care. I've been doing this for over 20 years, and I started in the business when I was quite young, and I found out quite quickly how important this really was going to be. I always thought insurance was a fascinating concept against the grain of most who may not feel like this, but I always thought it was the neatest idea that you could spend a little bit to make sure that you were protected. Basically everybody put their money together in a pot, and if somebody had a problem, you were going to be okay. I thought it was just such a great, lovely idea, as cheesy as that might sound, but it's true. So when I got into long-term care, we had family history of illnesses and people being cared for, but very early in my career, my father got quite sick, and my mom and I were the primary caregivers, although I have a big family, fortunately, and through that caregiving, my whole career was on hold. I was very close to having a hard time, and not just financially, but of course emotionally. And if my father hadn't had some coverage, and it wasn't enough because he really only bought it to appease me, we would have really had a big problem, more than we did. And I'll tell you, being able to stand beside him to the day he passed, and I know my mom and I have talked about it since then 100 times, but it was great to be able to do that without money being our desperation and difficulty, and it wasn't the same kind of burden that I know he'd on me as he was very fearful to put. So because of that, I just thought this was the greatest concept in the world. Do you mean you can buy insurance that pays you when you're sick or injured so you can stay in your own home and you don't have to burden your family and you're not going to run out of money? This just seems like an absolutely amazing thing. And it is, and that's what it is.
It is, but let's also talk about the reality of this. Long-term care insurance is of the different life and health insurances that are out there. Life insurance, disability, critical illness, which we covered before, and long-term care is the most undersold product in this country. I remember being at a conference once, and this was years ago, and the numbers haven't got any better, if not maybe got worse. And it was like, a couple hundred people in the room. And they said, okay, stand up if you sold a life insurance policy in the last year. Of course, it was all insurance advisors, so they all stood up. Okay, now sit down if you haven't sold, stay standing if you've sold a critical illness policy. And then it was down to 10% of the room. Then it was stay standing if you sold a disability policy. It was down to 5% of the room. And then it was stay standing if you sold a long-term care insurance policy. And there were two of us left.
Yep.
And it was myself and another gentleman who basically bought it on himself.
Yep.
So it vastly undersold. So let's talk about, because this is about insurance coverage and specifically that's going to help. Talk about what triggers a long-term care event. Like basically, what is it we're insuring against?
Okay, so this is part of the reason I have such a passion for this coverage is because, to your point, there are a lot of insurance coverages out there, but this is the only one I've ever found that is really based on the individual's symptoms and their need for help versus their income, who's doing it, what condition they have. So it's very encompassing. So the specific trigger on long-term care in general or loss of independence is your inability to be independent and you need help with your normal daily activities. Or, heaven forbid, cognitive impairment, which makes you require supervision ongoing because of safety, inability, judgment, reasoning, orientation, that sort of thing. Now, most people would rather me say this in very plain, non-insurance terms. So really, what this means is this is the only policy that based on the fact that you need help with from another person. So most of the time when people require care, whether it be because of a heaven forbid, a heart injury, a stroke, and natural aging, activities of daily living is your ability to get on your own. So think about your day. You get up, you have to go to the washroom, you get dressed, you get washed. So bathing, transferring, toileting, these are the most common types of activities that people need help with in so many environments, even young and old. So when somebody needs help with two activities, the claim is triggered. That is what triggers a claim. My dad had cancer in his situation, and yes, he was in a bed, but he was not an invalid. He got up, he moved around, and he was conscious, cognizant, but he did need help. And that's where this pays. It's not too good to be true, but it pays when you need help ongoing.
It's interesting. So a couple key points there. Bottom line is you need those types of help, whether it's cognitive impairment or physical, and those activities of daily living, you're going to receive a benefit. Now, contrast this to the other forms I mentioned earlier. Life, you're dead, you're gone, right? Like that's meant to pay for various things, including supporting your family, taxes, and some estate plan, some tax plan considerations. But on the living benefits side, which is the other three, there's this real kind of weird overlap between a lot of them, right? So disability insurance will protect you from becoming disabled, just like long-term care will. But the difference being that one ends at 65, typically. Some of them have lifetime policies, but they're also defined around your ability to work, right? And this is the same, similar, but different, right? Like, can you speak to the differences?
Well, and that's where I think a lot of business owners potentially are missing a mark on this type of coverage. Disability insurance, to your point, is the name disability gives some misconnotation because the reality is disability is triggered by your inability to do the job that you insured, as well as the the income that you're collecting. So as a business owner, where we can run into a pickle is if you have ongoing income that may continue even if you're disabled and was going to still be drawn, that could affect your ability to collect. There's also many business owners that have established a business that could go forward without them there on a daily basis and still allow them to draw income, let's say, and maybe that would not be applicable with a standard disability, but they could be disabled in the sense of true disability, needing care from somebody, and be collecting on long-term care at the same time. It's not related to your occupation or income, and often it will overlap on a shortfall of income with a business owner or provide them with a transition benefit from working years to retirement, because we have that gap with disability always.
Yeah. And then on top of that, you throw critical illness, which you could have a critical illness, not have a disability, not be cognitively impaired, or need working, not need long-term care. It's people often try to talk about using one or the other. The reality is all three serve very different needs. Similar, but different. So don't think one is going to do the job, but the others aren't. Now, you brought up an interesting point with business owners in that you'll have other forms of income and the business will continue on, and that may not get you a payout depending on the policy. The other issue is that you get to a certain level of net worth, they're just not going to give it to you, right? Like I've seen that happen where basically, no, your net worth is too high. We're not going to issue disability insurance because financially you'll be fine, right?
And to your point, really, we are trying to establish coverage for people in all scenarios that meet their needs and requirements. And if that's the case, if I can say to somebody, if you could retire tomorrow, would you be financially impacted? And they say no, I don't think I need to implement disability into their portfolio. But if I say to them, if you are paralyzed tomorrow and for 20 years need indexed care needs of $80,000 to $100,000 a year, that millions of dollars would be impactful, then that's worth protection.
Yeah, exactly. I think it comes down to exactly. It's not so much about the impact. Is first off, you're losing the human capital perspective. So you could basically lose a ton of income, but the income ends at a certain point in the future. But what you're talking about specific is different to long-term care is the ongoing care need, which is enormous. So frankly, yeah, it's drastically undersold. So let's talk about that for a sec. So why do you feel it's undersold? I've got my own working theories.
Well, I would like to hear yours as well, because these are obviously theories, because I don't have a problem with it in the sense of I talk about it all the time because that's what I do, but it's my specialization. So I sell lots of it. I never had an issue with it. It's common with my partnership advisors and people I deal with because they have a point of reference and exposure. I think one main thing, of course, is many advisors haven't brought it into their practice, and if they're not mentioning it, no one's going to know about it. When you say long-term care insurance, there are really bad misinterpretations of what that means. So people often think it means old age only, or it means, you're in a home. This has nothing to do with being a home. I'm going to pay you whether you're in your own home or in a facility or a hospital. I don't care. That's not the point. This is to provide the additional money you need when care is needed, which is generally between, $5 and $10 grand a month if it's ongoing.
Yep. And okay, so you haven't had that, but I'll tell you what I think.
Tell me, yes.
What I think is a couple of things. First off, I think it's indicative in that the other ones that are undersold, disability and critical illness, disability in particular, a couple of things. First off, I think a lot of people are just basically, they understand the concept of life insurance inherently because they've heard it forever, right? And it's given away at work and everything else. And there's almost like an expectation that, I buy a house or I have a kid, I need to buy life insurance. Like that is almost, whether it be commercials or their parents, I don't know how they got it, but there's an understanding there. The other forms are not understood as much as well. Secondly, it's easier to underwrite life insurance. It is. Like they look at the underwriting process is more strenuous for the other three. Third, Canada is an interesting country in that we have a fixation on fixed premium insurance, whereas other countries, there's a lot more variable premium insurance sold out there. Long-term care, as you know, does not have a full term of life fixed premium. There are adjustments potentially. I think that turns off a lot of people just for the lack of security. I'm not really sure why. And then the last part is that the reality is that it can be quote unquote expensive on the outside, I think. So I think you have a conspiracy of all these things coming together, plus it being newer, relatively speaking, to every other form of insurance. And that just let's just be honest. We know that insurance advisors fall into a couple of categories. There are a couple that basically there are plenty that will do the right job and do the research and know what you need and sell you what it is you need, but they maybe don't sell every form of insurance. There are those who do all of it. And then there's those who are just looking for the quick hit to move on, right? Like sell the quick term insurance policy. How much you have to spend? Great. This is the biggest thing I can get you, move on. And you can get term insurance issued, guaranteed standard issue with no medicals these days on up to $1 million in some cases, right? So they're looking for the quick turn. This is a I'm sure you can test, longer underwriting process on average.
100%. It can be. And again, that's where one of the many advisors know that to be true and where it can be difficult because it can be long and tedious. And using a specialist could really help with that because of the medical side, or at the very least doing diligence in advance of the underwriting because you have to. There's no option for this. If we don't do that, then you're going to run into really long processes. But yes, definitely more difficult to get than life insurance, which is a boast to get it earlier.
Well, true. But that's the other problem, right? More often than not, this is thought about as a later career stage type of coverage, right? So we're talking about post 65, people start thinking, well, oh no, I'm starting to face my mortality. I'm not going to live forever. I have maybe another 10, 15, 20 years before I need some sort of care. I should look to insure it now, right? I think that's a natural human reaction. Talk to me about how the cost differs when someone, say, who's 70 versus someone, say, who's 50 looks at something like this.
Well, again, you know what? This is a hard thing because maybe I'm a little Mary Poppins with my insurance views, which I know I am, but it's all about the length of time that you're going to be spending as well, right? I bought my policy when I was in my 30s. I'm presumably going to pay much longer than somebody who bought it in their 50s or in their 70s. So on the cost of really input, it's hard for me to say that or say exactly how I feel. But the cost difference, it is manageable. But here's where I don't think enough people understand. Long-term care doesn't come in one way. So there's two actual types of long-term care. So when I get clients that are older and cost is a factor, what we're looking at is policies that have a longer waiting period and things like that to reduce those costs. And to your point, those people have saved up. We're not trying to protect anymore for these short-term ailments and income loss like we were with disability or critical illness. We're really worried about that longevity risk and impacting the family or their assets. So something that has a 1-year waiting period that literally costs 30 or 40% less has never really been looked at because people haven't thought of it like that, but that is where the difference in that cost can really come from. And there are also other features that have been added that, again, can be very mathematically sound and worth consideration, not right for every person, but consideration are the return of premium on death factors on those policies. Those policies, to your point, there is some limitations on the premium guarantee, but sometimes they're putting on the guaranteed return of premium. Even if there was an adjustment, there is 100% protection in the capital put into that policy, whether you collect or you don't. So there are some safeguards to make sure.
It's interesting. I mean, I have mixed feelings on return of premium. I mean, depending on the product, some of them, I'm not a big fan of return of premium on death. To me, it's just like buying a little bit more insurance every month, life insurance every month. And I don't think it's really that relevant to me. Return of premium on DI policies where it pays you every couple of years, those can be very lucrative if you stay healthy. Now, further to your point though, about give it a year's, have a year-long waiting period to produce the premium. And I think this is a fundamental thing that I think a lot of people got to wrap their heads around. And I think as we know, there's somewhat of a general aversion to the concept of insurance in the world. My previous comment with a conversation was Zach Goldman. He basically had someone once say, just call it something else. Just call it anything else at this point, because, everybody always thinks of the car insurance company not wanting to pay them out, or the home insurance company giving them a hard time. And yet life and health people get painted with the same brush, even though I've never had a claim issue in my life. So basically you have that. Now, the waiting period on a year is perfect, or if not longer, is perfect. And for the standpoint of what we're really trying to protect against is not a small incremental loss. We're trying to basically take care of as you said, the longevity risk. So you have a semi-catastrophic event, right? You have an event that basically makes you unable to take care of yourself, but you're still going to be around for a long time, right? And that's really the risk, right? Is that you're going to basically, and you want to be around for a long time, assuming you're cognitive. The reality is that that's going to be a long and expensive road.
And with medical advancements, there are twofold to that. People are, of course, living longer with things, surviving things that they wouldn't have. So there is that true longer risk to longevity. But something you said earlier about qualifying, as we get more advanced with medical, they're going to be able to see things much faster, which is going to make it harder to get as we go forward without question. So I can't stress enough how things are going to change, and we need to take advantage of these things for planning. And I don't think this bubble of long-term care chaos is going to be there forever once our population shifts and things like that. But we got another 20 or 35 years minimum of this potential financial impactful consequence of living too long.
Yep. And it's only getting, it's funny. This was the year, I think it was the first year ever, or the first year in a long time, that there was a decrease in mortality tables in the US, largely due to the opioid crisis. But barring that, there's only one direction that thing goes, right? Like there is only one direction that thing goes. And just to explain to people how different things are, the story I always tell is the story of the first government pension, modern government pension, which was Otto von Bismarck in the German state, who basically in the 1800s launched a government pension that was originally targeted at people at, I think it was 67 and then moved to 65. And it was basically meant for people who could not, it wasn't meant so you can go on vacation. Like that wasn't it, right? Like it was meant for, oh my God, you're so old and decrepit, you can't work anymore, we have to give you something. So it was like old age security and GIS combined. But what people don't understand, so that was 65, and our retirement age has never changed from that. If you were to have adjusted that retirement age to mortality gains, the number would be somewhere close to somewhere between 93 and 98. So The reality is back then, people who made it to 65 could expect to live not very long, a couple of years. And now people make it to 65. We're talking at life expectancies of, 84 for women, almost 80 for men. And I always have to remind people, let's not forget that life expectancy is an average. So 50% probability you go beyond that. The joint probability on a couple having at least one person live past 95 is like 10% now, pretty close to it. So we're going to be around, most of us can be around for a while, barring incident and COVID, but we ain't staying healthy that entire time. So it's a challenge. So in particular,
with people living longer, they have this inability to plan, of course, but you're going to be, if you're a business owner and you get to retire at 55 because you've amassed a significant estate and your portfolio is great, you're going to be retired longer than you worked.
Well, I'll tell you, it's going to be, so this is a funny story. I actually wrote an article mentioning this. My wife is the teacher's pension plan's greatest enemy. She is scheduled to retire like early at like 54 or something like that. And her grandmother lived to be 106 years and 6 months.
That's what I mean. That's crazy to think you're really, and you are, and the planning, it's not really, you can't really get your head around it, but that's why this is so important and how impactful it can be in the long term, especially index plans. You buy a policy that's indexed at the age of 50, that's $100,000 a year of benefit, and it's indexed for life. By the time you get to 90, it's worth $250,000 a year. I mean, you couldn't do that.
So is your viewpoint just generally that people aren't looking at this early enough?
Yes, but and saying that, as much as I love insurance, everybody has priorities, and in very few situations between the age of 40 and 55 will a client have long-term care, disability, critical illness, life insurance, because there are transitions in these. And disability, often what I'll do is try to get a piece of long-term care started or discussed in those years, because their disability is going to end and we can reallocate those dollars effectively rather than trying to just always overlap. But the sooner we do it, the absolutely, without question, more value. And you said something earlier about that meeting room was stand up if you own long-term care or sell long-term care, and nobody did. And I've done that, of course, in talking to advisors saying, like, how many clients have you talked to about this? And nobody has. And I say, okay, let's reverse this. And let's say I said you had a business owner that walked into your office who is 58 years old, and 10 years ago they met me, and I sold them long-term care insurance. And so when they come into your new office and they say, and you're meeting them and you ask them what they have, and they say, oh, well, I have this policy. I only have 15 years left to pay because it's a limited payment, and it covers me unlimited for, 150,000 indexed for life. Would you tell them to cancel it? And the advisor
depends on how credible the advisor is. But yeah, I mean, you're absolutely right.
You wouldn't. It's a gigantic asset for his retirement. You could never match that. So how could you not sell that or talk about it?
I think you're right. I think, when we do our entire insurance presentation, we go over every form that's out there. And we basically, first thing I say is, we're going to talk about some unfortunate things. Second thing I say is, by the way, you're not going to get all of this, because if you got all of this, you need to take another job out just to pay for it all. And that's not what I'm after. So yeah. So, I mean, at the end of the day, it comes down to where are you going to allocate money to the biggest, hottest issue, right? And I would say you're probably right in that. I think for the most part, I think maybe disability policies carry on for too long, especially if you got an ROP on it. Like if you're basically looking at, say, a ROP coming to you with 5 to 6 years left, you're 59, 60, and you're hopefully by then, quote unquote, solvent enough that your retirement is a very real reality with very little deviation, then getting rid of that DI policy and looking at long-term care is probably a very smart move as a business owner.
Simply reallocation of that risk. And that business owner wants to make a calculated decision on the risk at hand, right? I mean, if they go buy all new computers and the computers are worth $100,000, they're going to insure them for couple $1,000s a year. This is the same concept. You're coming to retirement, reallocating those dollars to an insurable risk that's impactful.
Yeah, agreed. And if anything, as we said, it's the trying to transition, right? You get the state. There's going to be a stage where the DI becomes less important, the LTC becomes more important, and it just so happens that people probably think that happens too late, but it also happens at a stage where it still remains relatively affordable, all things considered. Because I mean, it's pretty pricey when you start quoting these things to people in their 70s. Because at that point, there's not much time to claim, right? So it's the old. People ask me, why is it so expensive? It's like, well, let's put it this way. No one wants to insure a house on fire. And I'm not saying you're on fire. You're not on fire. But let's say that you have a cabin in the mountains in California that are very much known for fires. Like you're not on fire, but the probability of you being on fire is increased. That's the issue.
There's only one, and when I started, and I'm not exaggerating, my second case of long-term care when I was brand new, so young, met her. Her name was Shirley. And she was 72 years old when I met her. I went to go talk about long-term care, and just as you said, it's very expensive. Shirley didn't have a lot of money. I met with her 3 times before she bought it because she said, should I do it? And I said, look, I don't know. If you don't buy it and something happens, you're going to be in big trouble. If you do buy it and the money that you're paying out starts to cause you to be upset or uncomfortable, then I don't know how I'm doing justice to your life here. But let's try it. We applied. Shirley decided to go with it, which was great. Less than 2 years. It was literally, I sold it to her in June of that year, and by December I got a notice that Shirley was diagnosed with terminal cancer and was given 6 months to live. She only paid for 6 months, and that woman collected for 6 years straight. It was one of my longest claims, and she only paid for 6 months.
There you go.
So you never know, right? That's the whole thing of insurance.
Well, I've had that conversation. I've had that conversation all the time. It's like, oh, this is going to be a terrible return. I said, yeah, if you die at 100, it's a terrible return. And actually, is it really? Because compare it to GIC rates, it's guaranteed.
It's not.
I said, you walk out of here, get by a car tomorrow, it is a bigger return than your lottery ticket in most cases. So, and this ain't the lottery. This is guaranteed. So it doesn't matter when it happens. For lack of a better term, it's like you're buying. For lack of a better term, it's not a lottery ticket. You're buying a lottery ticket that's guaranteed to pay. I wish lottery tickets were guaranteed to pay, but unfortunately they're not.
Yeah, I wish everybody took their lottery. Those people that spend money every week took that money and applied to this, because you'd have better odds and more applicable results.
Yeah, and more aversion. Yeah, it's exactly a more devastating thing. And I will say one other area I've sold into in the past in this, and actually have had more success than not, is in people who, 2 things. They've had a combination of personal experience where this sort of thing happened. They saw the cost go and they're like, whoa, like I need some help with this. And then the second factor was these people legitimately had the financial capacity to handle it. It wasn't about that. It was about capital preservation for the estate. They had seen how much of the parents' financial nest egg had been, and their eventual inheritance had been whittled away by all these care costs, and said, you know what, I would rather basically preserve it. So, we talked about life insurance, but they opted for the long-term care in particular because it also came with, a lot of these come with care coordination. So support from professionals to turn to on a dime if basically something goes wrong, right? You have that extra kind of expertise now that helps you navigate the system.
And that's worth more than people understand, because anyone going through it, just talking to an advisor yesterday, trying to get their mother, so she was sleeping on her floor for 5 days because she couldn't get someone to come and help, didn't know who to call. Care coordination is expensive and difficult. And more importantly, as people age, it's often a single person needing the care because they've lost their partner and they need an advocate in order to maneuver, or they're not going to get better or the proper service.
Yep. It's part of this, like the same value proposition that I give. It's like, not only is it all the stuff I do for financial planning, everything else, it's a simple fact that when anything hits the fan, you got to pick up the phone, right? And especially financially, like some of the crazy stuff that I have thrown my way that clients wouldn't expect me to be able to help with, it's quite interesting, because even if I can't help with it, I typically have a decent idea where to go. But in most cases, it's that reassurance. Like I said, basically, you're part of my value proposition is a form of insurance, that you have that person in your corner to call. So,
well, and a lot of business owners that are at risk if something really happens to them financially, a very significant impact, they need to consider this because it's a solution to a problem they have. A lot of, let's say, more established or affluent business owners look at this as an opportunity to diversify the portfolio and financially plan effectively. But through the same needs, it's there, and it can be applicable in both situations.
But the bottom line is, if people are listening to this, and there's two groups of people listening to this that I've been told: financial advisors, big surprise, and business owners, thankfully, hitting my target demo. So I think the takeaway message from all this is advisors need to talk about this more, educate themselves on it more. And there aren't that many products out there in the market, right? There's only a handful. There are some interesting twists and dynamics to all of it and differences that we need to educate ourselves on. Jed might be a good resource for that, just saying. And then secondly is as business owners, especially if you're in that kind of sweet spot of, you got into a certain level, you're probably around in your 50s, probably. The DI is still a value, but you maybe built that nest egg. And that's kind of like the sweet spot for me. But frankly, it's a conversation that should be had across the board. And if there was one of those things where if there was fiduciary responsibility put upon insurance advisors, it would have to be had. So let's just act like that anyway.
Exactly. Just mention it. And you know what? People can make informed choices. And it may not be immediate, but it's in your head now. And things as they come up, at least you can refer back and not think there isn't an option for this, because there really is. And there's a fabulous one. And it's going to be gone sooner than I hope it will. It's not going to be here forever.
Well, I think you're right, because I think the liability to the insurance companies is bigger than they understand, which has been proven in the States and other cases. And also, it's not selling enough. It needs to sell more. And
that's our saving grace, because I think if it was mass sold, I think they would have changed it by now.
Yeah, well, they changed it years ago. They pulled back on a lot of the benefits. They made it more prohibitive, but we might see it get more prohibitive in the future. So strike while the iron is hot. Anyway, Jen, this has been great. Thank you very much for your time. Where can people find you?
You can reach me at jjacobs at LTCI, so long-term care insurance, consulting.ca. You can reach me at www.jenniferjacobs.ca. Or my number, the office number is 905-829-4984, and we're there if you need any help.
Thank you very much for your time.
Okay, have a good one.
Appreciate it. So that was this week's episode of Financial Planning for Canadian Business Owners. I hope you enjoyed that, and I hope you enjoyed understanding and learning more about a seldom discussed and poorly understood form of insurance that can be of incredible tangible benefit, especially when the unforeseen and the things you hope to avoid in old age do happen. It's going to happen to more of us. As always, if you enjoyed this podcast, please leave a review on iTunes, Stitcher, or wherever you get your podcasts, and take care.
This podcast was brought to you by Woodgate Financial, an award-winning financial planning firm catering to high net worth individuals, business owners, and their families. To learn more, go to woodgate.com. You can subscribe to this podcast on Apple Podcast, Stitcher, Google Play, and Spotify, or find more episodes at jasonpereira.ca. You can even ask Siri, Alexa, or Google Home to subscribe for you.